This is the next generation, what is required to get deals done in Europe. Background to the panel is back in 2007, some pioneering young sector professionals thought that the sector didn't speak well enough to each other below sort of managing director and director level. So the NGN, or next generation, is essentially a social network for under 35s in the sector. And the panel today is made up of members of the NGN. Each of them will have their own views, and hopefully you'll have a bit more of an independent view from people further down the organisations than you perhaps get sanitised on some of the larger panels. We're really hoping that it's interactive. It'll be a lot more entertaining for everybody if there's questions from the floor throughout. And hopefully the subject matter will be relevant to you. Just one caveat, the panel were selected with the name of the title of the panel being How to Get Deals Done. And so as not to expose them too much, there's probably more UK experience than there is European experience, albeit we will be touching on continental Europe as well. So I'll let the guys introduce themselves and we'll commence. My name's Kerr Young. I'm a director of Christie & Co. Previously worked in the consultancy team and then into the investment and development team. Spent 18 months on secondment at Lloyd's, looking at a number of large portfolio debt deals, and now based myself in Edinburgh, looking at investment development and corporate hotel transactions.
Hi, I'm Lisa. I work with Invesco Real Estate. We're an institutional hotel investor. I come from a hotel background and found my way to real estate after graduating from Lausanne Hotel School. Then went to work with HVS for some time. I spent some time with Marriott, CBRE, and then most recently for 3 years now with Invesco. We have a dedicated hotel real estate team that forms part of the wider Invesco Real Estate Group. We have 30 hotels to date across Europe, so we do have a pan-European focus, and hotels account for roughly 22-23% of assets under management of Invesco Real Estate across Europe, so it's a strategic focus that we have as an institutional investor.
Charles Scudamore, principal of Heatherly Capital Partners. Set up Heatherly a couple of years ago now. Prior to that, I was in the advisory space, and I suppose had enough of kind of advising other people how to make money and do good deals, and decided to do it myself. So set up Heatherly. In the last year or so, we've acquired a couple of limited service hotels in the UK. My specific focus is originating, structuring those deals, getting deals, and we're unashamed with bottom feeders, so limited service hotels in secondary provincial markets. Buying those hotels, and on behalf of our investors who come on board, syndicate of investors there, we trade those hotels through to an exit, which is probably 3 to 5 years from acquisitions. So, in a nutshell, that's me.
Matt Walton, Relationship Director at Barclays Bank. Been with Barclays since May last year. Previous to that was Royal Bank of Scotland in the same role. So I'm in the part of the hospitality and leisure team with a focus to hotels. I have an existing live portfolio of hotel clients. Obviously serve them on a daily basis and looking at new deals for those, and also new to bank deals. I guess the majority of stuff that we do is a lot of refi work, acquisition finance, portfolio acquisitions. We are relationship driven and led. So we've done a bit of stuff in Europe, but it's purely UK out.
Tina Yu, I'm a senior associate at KSL Capital. Been with them for the past 3 years, and recently moved to London to join the London acquisitions team here. We're a $2.1 billion US dollar fund that invests solely in travel and leisure businesses. So that translates into hotels, ski businesses, golf, membership clubs, and in the UK, we recently invested in the Malmaison Hotel de Ville portfolio, as well as the Belfry Resort in Birmingham that's managed by De Vere.
Thank you, everybody. Just before we get into the panel, we previously run this session 2 years ago, and I'd just like to time has moved on from then until now, and just some of the crystal ball gazing that came out of 2012 and where we were in the market. Certainly from where I am today and looking around the conference, there seems to be a lot more people talking about deals than there was certainly back in 2012. There was lots of finger pointing at banks and people that over-leveraged deals. And I think where we are today, I think is reflective of where the panel's views were in 2012. So, there's still stressed capital structures out there, and certainly that has manifested itself over the last 2 years. Certainly there's a feeling that we're probably getting to the end of that, and it will be interesting, particularly in the UK and across Europe, off the back of a number of the debt disposals that have freed up balance sheets of the majority of the lenders that were perhaps seeing some problems. That should allow more liquidity to come back into the market. Charles has touched on his bottom-feeding targets, but actually at the same time we've seen a polarization of the market. There's certainly at the same time a flight to quality. And again, I think the key to everything is understanding the capex, which will no doubt is still a case today, still an issue today, and we'll no doubt come on to that. I think from certainly Lisa's point, or from a funding perspective, lease deals are certainly hot topic at the moment, certainly in the UK where Premier Inn are transacting at extremely sharp yields, and Travelodge, having gone through their CVA, are coming back with a huge amount of weight chasing those fixed lease deals. And then 2012, I think we have seen the flight of money into the UK, and it'll be interesting to see Tina's views on going forward on whether that's expected to continue. And then finally, yes, I think we're happy that there is money going into international markets and from new sources. So I think we're happy with where we saw 2012 and where we are today. And really, the topics for today is how to get deals done. So turning to Lisa first, from your pension fund, you could invest in shopping centres, in hotels and offices. What is it that you look for when you're investing in your hotel assets?
What we like about the hotel sector is that you basically still get an attractive premium for your real estate investment compared to office or residential, for example. At the same time, we don't consider it significantly more risky than these investments. Investors actually co-sponsored an IPD hotel index to basically make hotel investments more accessible for more mainstream real estate investors, and that actually proved that the perception that hotel investments are necessarily more risky is misplaced, that the volatility of investment returns is actually lower than in other sectors. Still, you're getting a yield premium if you get it right, if you invest in the right kind of structures, in the right real estate, and if you understand the operating business you're investing in. Invesco is as an institutional investor, we invest into leased hotel properties primarily, but that doesn't necessarily mean fully dry leases. So we like to have exposure to the performing business through hybrid or variable leases, because we believe that's where you get the best combination of the real estate investment and the hotel investment, which we consider a strategic growth sector. Just looking at some international travel numbers and so on, it's all pointing at the right direction.
So with the hybrid lease structure, you don't see yourself as a passive investor. You're very much hands-on, looking to work with your operators.
Yes.
In order to actually have an influence over what your income is.
Exactly. We like to consider our tenants as our long-term partners. We are normally in with them for 20, 25, 30-year leases. So there needs to be a good relationship with your tenant that, that in most cases is a living relationship. So it goes beyond the pure written contract, but you have regular contact with them. You want to understand the business they're in, because on their success depends your success.
And Charles, the leased hotel model is something you've avoided?
Yeah, I mean, the lease hotel model is not something that we do. I mean, we've got a very, very simple business plan, which is, limited service hotels being appropriate to those markets that they trade in. We get a management team, the likes of Interstate, then Hospitality. We've had conversations with others, Q Green, BDL, to manage those hotels on our behalf. So we let them do that. They get on with that. We, if we can, I mean, the success of our deals is based on the backdrop of the market opportunity. You've got to believe the market opportunity within which that hotel sits and buying it at the right price. That's as simple as it gets for us. I mean, we don't have a long decision-making process. We can make a decision instantly. We've got a really good relationship with the guys at RBS NatWest who have supported us on all the deals that we've done so far and the stuff that we're looking to do. It's a question of taking advantage really of other people's misfortune. Those hotels that were originally developed back in 2005, 6, 7, and 8, effectively over-leveraged, coming to market now in some form of stress, whether that's full administration or a bank-led process. I love that one. We take advantage of those situations and looking to do as many deals as we can. So, I mean, for success for us for the next kind of couple of years, we'll be replicating the deals that we've done so far and maybe doing half a dozen a year or so.
And Tina, you've obviously got an operating platform, but you've also got third-party managed assets. What's the rationale for having those two different strategies?
I think in the UK, what we were looking for in investing in Malmaison was a product that showed consistent consumer demand even throughout the recent recession. B, two brands in Hotel du Vin and Malmaison that had good positioning within their local markets that were able to drive real significant rate premiums, and a management team that we really had confidence in investing behind, not just in terms of driving the existing portfolio of 28 hotels, but also wanted to back and deploy more capital in the next couple of years behind. In investing in the Belfry, what we saw was a resort that was the 4-time host of Ryder Cup, has the Brabazon, world-famous Brabazon golf course, and was in Birmingham, UK, where you could drive to, train to, fly to anywhere from northern and southern UK, particularly London. And the physical product didn't meet those expectations the consumers had of the Belfry Resort, and that's why we've put £25 million, brought in a sophisticated manager in De Vere, which we saw could really drive the group sales and conference and meetings market. So I think it's opportunistic, but we typically like to look for platform plays and invest in management teams rather than third-party operated.
Okay, and I mean we've talked about management, whether it's third-party or indeed movement of the brands. I mean, you Charles, you speak of the BDLs, the Q Greens, whoever it might be. What differentiates one from the other? What do you look for when you're partnering that manager to that asset?
It's competency. I mean, God, it's simple stuff. You want to know that the management team you put in place are the best management team for that position. I mean, we've got no. We're not necessarily tied to one individual management team. We will work with any management team that we think that we can get the best out of that hotel. To date, as I said, it's then Hospitality runs the Holiday Inn Express in Dundee for us, and the Interstate guys run Leeds Armories. The specific decision for Leeds Armories, I guess, you look at Interstate and some of the purchasing power that they can bring to the cost of that hotel. I mean, a lot of the reset of that hotel was ripping up the existing operating contracts that we had and affecting a change in things like IT, televisions, laundry, linen suppliers, all of that. I mean, it's simple stuff, but you can affect a cost saving through that process. It's worth mentioning that they run another 22, 23 other Holiday Inn Expresses in the UK. They have an understanding of that model, and they're a very a vocal part of, they've got a very strong relationship with IHG. So we want to take advantage of that. I mean, we are, it's pretty simple stuff. So, I mean, you have to recognize when there are opportunities that come to us via the management teams. Obviously, they've got to say, they've got first dibs, as it were, on that management opportunity. We've got to be honourable in that sense. But are we aligned to any one manager? I don't know if there are representatives of the management teams in the room, but I'm afraid not. We're open to working with anyone.
And sort of the power of the brand versus the power of management, Matt. We've got either side of you. In fact, all along you've got branded hotel owners, some soft brands and some hard brands. What is it that you look for in the management team and the brand when you're looking at your lending?
Yeah, I think as ever, management is key to any deal and underwriting any deal, and you look for whether that be the actual hands-on management, the key advisors wrap around any transaction, and the calibre of them and the specialism that they have in their part in the puzzle is huge. And we spend a lot of time looking at that on that management from a brand side. I think and this is sort of a debate I have with a lot of my clients, especially within sort of central London assets, and it's question which is always asked, brand versus unbranded, and it comes back down to that location and how that asset is run and what they really feel like they can. If it is unbranded, switching to a brand, what impact is that going to have on bottom line? And for us, any deal, it's cash flow. So it's an operating business. So we look at cash flow on every single deal. So it really is what impact is going to have on that bottom line cash position.
How much comfort can you get? Because the Hiltons, the Marriotts, they'll tell you put our brand on an unbranded asset and it will do better.
Yeah.
But there's always a cost to it. So how can you and your borrowers get comfortable that actually the forecasts that the operators are saying that they're going to achieve will be achieved?
And that comes down to the due diligence, which is one of the points on there, and how much actually work is done that, and really going through the P&L on a line by line basis, and really getting to know exactly what that cost is going to be. Sort of Charles touched on in terms of some of those just around the IT side and linens, a simple costs that you can reduce that is going to have on bottom line on cash flow, which is obviously in terms going to help service the debt and obviously potential to obviously a bigger debt quantum because of that leverage position. I think with the brands on that side there, it's having those discussions with those brands and that management team, and for them to actually exactly understand what is within that P&L.
And Tina, you've spoken already that you're in control of an operating platform now, but yet you use a third-party manager on the Belfry. What was the rationale for outsourcing management on your first acquisition to the UK?
I think for us, we've been a long admirer of Malmaison Hotels de Ville as well as De Vera's. Our team has been coming over to the UK for a while, and when we bought the Belfry, we really wanted to put in a management team that was able to be a true UK brand and to understand the UK consumer. And when you look at De Vera, I think it's one of the few, outside of Malmaison Hotel de Ville, one of the few UK brands out there when you're not trying to go for the big Hilton Marriott contracts, and also someone who could drive that conference and events business into the facilities in the Belfry.
Lisa, you've got a variety of brands and a variety of owners, and clearly with the lease structure, you've got to ensure that you've got a good covenant. But you've got a variety of management companies and you've got a variety of brands. Which one do you look for? Which is most important to you? And would you be comfortable having an unbranded asset in any of your funds?
Well, I think in general it's really horses for courses. So there are certain markets where you need to have an international brand that has, if you go to a market like Paris, like London, you want to have an international brand because you have an international travel base. If you go to a smaller local market like we've recently done in Germany, you might not necessarily need that because the traveler profile is basically different. So a local brand might have greater strength there. So when we're assessing opportunities, we generally look at two things with our operators. It's the covenant that is obviously very important, but of equal importance is also their operational know-how. I mean, as the rest of the panel alluded to, we want to make sure that the people that we enter into long-term leases have the right operating platform, know how to operate the hotel, and basically the right fit with their brand in that market. As I mentioned, we don't like dry leases too much. We like all kinds of forms of exposure to the operating business, even though it's a lease. And as part of our analysis with our operating partners, we want to have also a high level of transparency. So, for example, even though our rent might be based on a percentage of turnover only, we would still expect to see full P&L coverage to make sure that our operating partner is making money and it's profitable for him as well as for us, so that we have a market level rent.
And how happy are your operating partners for you to have sight of their P&Ls? I mean, surely the counter argument is, well, we're here as a tenant, we'll pay your rent, and this is our business, not yours. I mean, how do you work with your operators, and indeed, do you think you can add value to them?
Well, because we have different lease structures and different brands, we obviously have a certain understanding of how different brands operate. But the reason why they run the hotel, not us, is because we trust them to do a better job with it than us. We're not running the hotel, so we're not asking to have a say in, the cost of linen for them, but we want to know.
It's important stuff, cost of linen.
Of course, but you're probably more savvy with that than me, so therefore you would be the operator, and it's different mix of risk profile, So it's a matter of giving them the liberty that they need to operate the hotel to the best of their capabilities, but it's our stake in it as well, so it needs to be the right balance.
And you've got primarily a European fund. You've got one asset in the UK. Is there economic reasons, political reasons why there's only been that single investment in the UK, or has there been barriers to stopping you from deploying more capital into the UK?
Our two dedicated funds are euro-denominated funds. So first of all, if you go into the UK, you would have to consider currency risk as well. At the same time, we think the UK is a very attractive market, and we continue to look for interesting opportunities there. It's just that leases historically have been more dominating the market in places like France and Germany, and are only increasingly getting available in the UK with people like, for example, Hugh Green or third-party operators that have been mentioned.
But in the UK, you've got a variety of budget hotel stock, whether it's Premier Inn or Travelodge, all very happy, very comfortable signing up to leases. Why has there not been any investment there into the budget hotel sector?
We generally like the mid-market segment, so 3 to 4 stars. We think it's the right marriage between the real estate business and the hotel business. If you go to far luxury, very often the real estate is more dominant. If you go to far budget, you have a greater focus on the operating business. With the likes of Travelodge and Premier Inn, very often you have just dry leases, which we're not a big fan of. At the same time, they're selling at very sharp yields, and often are more similar in their nature to a corporate bond, if you like. You might not necessarily get the transparency of the P&L, and we prefer a different kind of lease. So the pure dry lease we find is interesting for other institutional investors. We have a dedicated team that understands hotel trading, and therefore we're penetrating a different niche.
Okay. And everybody talks about due diligence, and Charles, you're an ex-consultant. You love to analyse the P&L, but talk us through your sort of the start of your process, and really what due diligence you see is being required, and do you see that increasing or decreasing over time?
Increasing, decreasing. I mean, my background was with TRI as one of the directors there, and so my DNA is in analysis and consulting. I got to say that we've yet to commission a feasibility study, so I'm not quite sure what that says. But I mean, our primary point of care really, and where I spend most of my time, is making sure what the bank they get, what they want they get. So in terms of the analysis of the market opportunity, we've worked with them to put together a pack of information which goes through what they require and some of the questions that they're obviously going to answer. To ask. So we preempt those questions by providing them the information at the outset. Now, not necessarily, I mean, it's not rocket science. It's just providing the information. So we do our own. So we do our own DD. We get the Interstate or the Q Green guys or the BDL guys, or whoever it may be, to do a set of numbers which they feel that they can stand behind, together with a kind of market assessment, and that goes to the bank. They come back with a yes, no on this is how much that we're going to lend, and on that basis, we frame our decision to acquire it or not. I mean, it's as simple as that. So everything else is just unnecessary from our perspective, and so therefore we can make those decisions quite quickly. I mean, we can go through that process in the space of 2 or 3 days, and hopefully that allows us. Well, it has allowed us in a couple of successful instances so far to close those deals, which from a standing start is hopefully okay.
So 2 or 3 days to sort of get comfortable with the deal. Is that the speed that you'd be able to work to, Matt?
I'll jump in there, yeah. So I think, as Charles said, and it is, and I said right at the start, it's relationship driven. So the better relationship that Charles will have with his bank, or any sort of owner operator will have with their bank from the outset, means it gets rid of that having to go completely back and forth with information. It's not rocket science at all what information is needed. So it's actually that's presented, and it's having a good understanding and a discussion around that P&L and where those pinch points are, and the amount of sort of deals I get through sort of on my desk, and you'll be amazed a lot what you see, which are just sort of hockey stick projections where they're going to suddenly come in, take an asset. What are you going to do actually different to the previous owner? And I always sort of question why, and it's really around the assumptions behind those numbers as well, rather than just the actual numbers themselves. We will sort of AMPM as a tool is a great tool to go in and have a look of the competition around there and what potentially is going to be plugging into that marketplace. And that's sort of really, in terms of the turnaround process cycle, it's credit committees are and the process what it is. But if it's a good deal, exactly that 2 to 3 days is what something can be turned around in.
Yeah, I mean, I think the other thing I would say, the sector there is transparency in the information. There is, there's STR, there's TRI hotstats, there's AMPM hotels. You just got to know where you need to go. I mean, if you know where you need to go, you can get that information the same day. So why can't you make a decision within 36 hours? I mean, if you're sure of the market opportunity and you're comfortable with where you can take it and where you think from our perspective, where we think the hotel management team can take it, then it is a very quick decision.
It is, and it's the wider story as well, and the piece it is about that relationship and that strategy and what we can do 2-3 years down the line as a partnership on that side, which is key for us. And other ancillary income, share of wallet for that as a trading, operating business that it can generate. It's that full story which adds weight to the transaction itself.
The guys have spoken about transparency and improved transparency in the market, particularly in Europe. Coming from the States, I mean, how opaque or transparent do you find the sector over here compared to what's happening in the States?
I think there's a big difference between the States and Europe, but there's also a big difference between UK and continental Europe as well. I think STR reporting is a lot more transparent in the UK than it is in continental Europe. But one of the advantages I think we have with being a full-service owner-operator with 28 hotels around the UK is a lot of times when we're looking at a new deal, we're benchmarking it to our own Malmaison Hotel de Vin. We see all the market trends within those markets. So that's one of the advantages we have in terms of data transparency. And I guess back to the diligence point, while we are a sector fund and we do all of our in-house business due diligence, I think because we are ultimately cash flow investors rather than making big macroeconomic bets. I would still stress the importance of due diligence and kind of taking your time and going down the P&L, particularly for more complex assets like the Belfry, where there's a golf operation, there's a membership component, and a rooms component. So I just, in terms of stressing the more complex underwriting side of things. And then in doing deals in this day and age, I think it's really important to can look at the property conditions diligence still. I think there's a lot of properties that have been underinvested in that are coming to market, and whether it be back of the house or front of the house stuff, I think it's important to do your homework there.
Sort of the capex requirement. I mean, how clearly there's been some tired assets put onto the market recently, and owners and operators will point to banks to say, well, we weren't allowed to spend on the asset because you were taking it for debt service. I mean, how have you seen any change in what you're doing from a banking perspective to ensure that there's a capex slush fund to go into assets?
I'd say sort of the opposite. The capex, as you sort of the first slide, sort of 2012, and it's still there, that need, and we, as a bank with my clients, we want our clients to spend money on the asset. As simple as that. It needs, it needs to be done. That's why, regular sort of visits to the asset, and there are some tired assets out there, and there's a lot of sort of cosmetic work been done, near enough just putting a plaster over it, but it's really behind the scenes. And we've always, and it's however the deal's structured in terms of on the covenant side, it's done correctly in order to allow capex, not just your general maintenance capex, but also any other exceptional items. And a lot of those haven't been done, I think, and a lot of guys are holding off on doing that, which is a worry.
And Lisa, you're a landlord to a tenanted estate. I assume you're just happy to collect your rent, look at the P&Ls, and know that the property will get handed back in good condition at the end of it, or how do you interact with your owners, and more importantly, with also the brands under the lease model?
Yeah. The most recent investment we've done was actually involving some capex, where basically we looked at some existing hotels. We bought them. We wanted to have a longer lease in place. We negotiated new leases, and in turn, we agreed to on acquisition actually to a substantial refurbishment of two of the properties. It works for the property because it is in a better placed position to generate the rents that we needed to generate. At the same time, if us together with the operator decide on the right refurbishment program, then there's going to be increased performance of the hotel, which then should benefit both parties.
And you've flagged a couple of your assets that were previously unbranded. How helpful have the brands been to accommodate, and do you find that their requirements from property improvement plans to be onerous to you being able to structure a deal?
Well, it's all a negotiation, I guess. So, of course, when you take a new operator to an existing property, there's going to be a wish list of things that they would like, and there's going to be a wish list of things that we would like to pay for. Or, well, there's a certain gap between those two very often. And you got to make sure that you strike the right balance there. So, yeah, it's really on a case-by-case basis.
And Charles,
I've got an answer to that question. We're going through the process at the moment of an independent hotel to a brand, and I won't name names because I think that's probably unprofessional. But it so far has been, I think it is it's slow going. And what's frustrating is that you've got to realise, I guess, that these are big organisations and there's disconnects between the teams that that work within those organisations. So you tend to get left or passed between different individuals within that same organisation. So from my perspective, it can be hugely frustrating when you're working very quickly and working to a deadline that you think that you can deliver, and other people's diaries and commitments get in the way. But it's just part of the course, I guess, and it's a learning process from my perspective. But I think, in short, in answer to that question, hard work is what I would say.
And you spoke about being able to be in a position to sort of do a deal within a few days of looking at the asset and having a look at the P&L.
We'd make a decision on the deal within a few days.
And then how long after that do you think?
So then, I mean, it's all about, again, the banking relationship and what they require. There's probably a couple of weeks in terms of putting the information together. This all assumes a provision of information right at the outset, and that's been another frustration of ours, is that you make an offer, you get it accepted, and then you wait for the vendor solicitors to provide the information. And sure enough, 6 weeks later, you're still waiting for the body of information to come across. Basic stuff on title of the hotel, and there are agents and others phoning you up to find out what the progress has been. And you go, right, well, we haven't even seen the title of the hotel, so that's a frustration. But there are lots of people involved in this process, and unfortunately, it is. There's only a certain amount you can do.
I think maybe just to add to that, the financial crisis obviously had a massive impact on hotel developments as a whole, which had an impact on the pipeline of brands to grow their brands with. And I would think that has added a lot of realism to some PIP requests, and hopefully has given you, Charles, for example, more discussion points to address with them, because there's obviously less developments out there, more refurbishments, and more brands competing for it, because it's not only the Marriotts and the Hiltons and basically the big boys out there, but there's a whole lot of competing brands now popping up, and they have an interesting value offer, so that should help with the.
It should help. I mean, there is, had a walk around on a property a couple of weeks ago, and it's all very touchy-feely, and I like this colour, and this colour accentuates this colour, and all of that stuff. And you sit there and you just go, this is going to cost a fortune if we, do everything that everyone wants to do here. There are some basic and big things which need to be done in order to reset the hotel. If you're taking a hotel which has been underinvested for the best part of 10 years, you can't expect just to stick the badge on it, and for the brand guys to be happy with that. They do require something in return, so you've got to be realistic there. But equally, I mean, it is about it's an opportunity for them, as a flag in the map, and we would hope that there is an ongoing conversation that we have with them. It can be fraught sometimes, but I guess we're still talking, so it's a good thing.
And Tina, sort of pitfalls or anything that you've learned from your processes to date that you've been successful on, or indeed any that you've been unsuccessful on? What's stopped you from doing more deals?
I think there's a lot more competition out there in terms of capital chasing the deals. While deal volume has certainly picked up in 2013, when we bought Malmaison, there was very few investors out there investing in regional UK, and now it's sort of the hot topic of the conference. So I think there's just a lot more competition driving up the prices, and sometimes the bid-ask gap hasn't completely closed. So pricing's the one thing that's stopped you from doing deals. It's nothing other than that. There's sort of the deals are there, and subject to price, you're there to do them. Yeah, I mean, I think there's just a lot of. It's not just U.S. private equity money like ourselves that's come over to Europe, but it's also high net worths and sovereign wealth capital. I think everyone's looking for yield in Europe right now. So. It's a lot of capital chasing the deals that are out there. And there's sort of a feeling that there's more debt in the market than there perhaps was when we last had this panel back in 2012 now, but not perhaps to the same levels as 2007. Does the levels of debt available and the lack of leverage, does that have an impact on the returns that you've had to seek when investing? It's funny you ask that. I think we've always been cash flow investors, I've said before, so I know a lot of private equity guys come up here and say that they don't over leverage, but we really don't put more leverage on our investments than we think the cash flow can support. And while I think availability of financing certainly brings liquidity to the market and brings more volumes and transaction out there, we never use leverage to juice our leverage returns beyond what we think is prudent. So.
Yeah, I'll jump in. Just in terms of what you said in terms of debt, debt out there, pricing's at its all-time low than it has been for a number of years, and there's also a lot of non-bank lenders as well that are coming into the market as well, which are having and then also a lot of, you know, what we're seeing is a lot of overseas banks coming in as well, with a lot of the high net worth clients coming in. And again, so the, you know, credit is easing and pricing is going. So there's that competition there. And, you know, some of the private equity funds as well have some, not only some of them have sort of mentalities of sort of, you know, either use it or lose it, which has a concern in terms of just chasing that price and what that impact is gonna have on the wider market. And we are, you know, as humans, we are pretty greedy, and hopefully we're not going back to the same cycle as we did, you know, a few years back. And that's the only, I guess, concern that potentially might happen.
Charles, Tina talks about the regional UK market hotting up. Now, you were perhaps pioneering a couple of years ago that you were chasing those regional deals. Do you find this sort of additional money that's chasing deals in the regions is going to price you out?
Yeah, I find it annoying that other people are getting involved, but how dare they? No, I mean, undoubtedly there's more competition for some of the deals that we've looked at, and we've missed out on a couple on the basis that we just couldn't, it just didn't stack up for us on price, and they have gone for those prices. So that in itself kind of shows you the number of people that are looking at some of those deals. But I mean, it's also, I mean, you know, when you're looking at kind of sub £10 million assets, you know, you're not dealing with institutions in the sense that KSL or anyone else. I mean, there's all sorts of individuals. It can be a syndicate of local businessmen, like the idea of owning a hotel, and they club together, and you know, they're at whatever they are, and it might be their first hotel deal. And if they can make it work, then great. But it's not going to be at the price that you know, that we can make it work at. So we just step out at that point. I mean, one of the things that we are absolutely, and you know, personally myself, really disciplined to is just take the emotion out of it. You know, there is no emotion in the hotel acquisitions that we make. It's you know, completely it's completely commercial. So if it doesn't stack up just from a commercial sense, we just walk away. We don't get married to the stock or tied to the opportunity. It's just if it stacks up, cool. If not, you know, there's other stuff to do. So, but it is annoying that more people are getting involved in the regional hotel space. And I'd encourage everyone to go out there with the message that there isn't opportunities in the UK hotel market, in the regional hotel market. You know, stick to London, Paris, and elsewhere. Thank you.
Lisa, you recently announced a large deal in Germany. Do you see additional competition for those large ticket deals, or is it limited to the few?
Well, typically the people looking at large portfolios very often also look at management contracts of late, if you're talking about North American private equity, for example. So they don't necessarily look for the same kind of product we do. Germany or continental Europe is a market that is very interesting for us, and there are getting more and more people interested in it, because very often in places like North America you don't necessarily get the same yield as you still get in Europe, because it is a bit more complex over here, and it's a lot of hard work to put such a portfolio together, for example. It takes time. Hopefully we'll be able to do more, and I think for the market in general, it's good if people do these kind of transactions, because it improves the liquidity and it improves professionalism in the sector, but maybe not too quick. So same argument as Charles.
Stay away.
And Tina, you've got you've obviously got a UK platform, and it's what's the strategy next? I mean, you've got somebody here who's investing into leases in Europe. Is there aspirations to jump across the channel?
Yeah, absolutely. I think it's through two lenses as well. So I probably spend 50% of my time looking at deals for the fund, both in the UK and continental Europe, that have nothing to do with Malmaison or Hôtel de Venne, and then spent 50% of my time pursuing single asset and portfolio deals that helps expand the two brands and the platform, because we believe the platform is really scalable within the European hotel market. And kind of speaking to comparing the European hotel market versus the US, I think one of the things that attracted us out Europe is the fact that there hasn't been the same proliferation of big brands and the same consolidation of ownership. So you still have a lot of hotels out there that are independently owned by private individuals or independently operated, and the distribution system there, the revenue management systems there are just nowhere near as sophisticated. So the fact that we have an owner-operator that can plug into that system is what I think we are really excited for in the next couple of years.
And Matt, you've got a variety of options here. You've got the owner-operator at the end. You've got the sort of third-party investor with management contracts.
Pick a favorite.
And you've got the institution that likes their leases here. I mean, where's your preference, and where's your money going to be getting invested?
Yeah, I know it really is. Every single deal is looked at on its own merits. We've got just my portfolio at the minute, which is sort of a point in terms of clients that are building up strong credit balances. Debt is amortizing down, and they are in a position where they want to buy, but they are just in a position where they're getting priced out from that side. And then obviously the breadth of what we do in the team. Say we are UK out, so we will big regional portfolio transactions, global refi, some refi in Europe. From a lease side, we see that as a real estate transaction. So our real estate guys will look at that from a
So even if there's an element of turnover or profit share, where, as Lisa said, that you need to have an understanding of what's happening in the business. Your view is that that's a real estate deal?
We will work with them in terms of our real estate guys, and it will be a joint approach looking at that. I know Lisa and I have had many conversations around where that sort of sits, but that is so it will be a double-headed view. Us looking at the operational risk side from that bank point of view.
And are you seeing more competition on the assets that you're looking to fund?
Very much so. As I said earlier, not just from existing other sort of, well, the likes of obviously RBS, NatWest, Santander, and Lloyds, but also from a lot of the non-bank lenders as well coming in, and overseas banks as well, which are coming in. So there's a lot of competition at the minute, which is obviously I think good for the industry as a whole, rather than before deals necessarily weren't getting done, we might be losing deals to other institutions, which is obviously not what we want. But
so you don't want to lose your deals, and Charles doesn't want to lose your deals. So.
Very selfish people.
Yeah, too right. Yeah.
We made some crystal ball gazing assumptions back in 2012, but I mean, sort of just conscious of allowing the room to ask some questions to the end. But I mean, how do you see the markets changed over the last 6 months, and what's your big bet for happening over the next 12 months?
Do you want to, I'll go first. I wish I'd set up Heatherly probably a couple of years before I did, actually. So we do see more coming to the market. There is more competition. It's going to drive up prices, et cetera, et cetera. So I mean, it's frustrating from our perspective, the newfound positivity in the marketplace. But that is undoubtedly, a current trend. It's probably going to, I guess, probably going to go on for another kind of 12, 18, 24 months. It's a cyclical business, and history repeats itself. So hopefully Heatherly Capital Partners is around the next recession to take advantage of it then as well.
Yeah, so I think, as I said, the only sort of concern is that element of human greed, and in terms of people really chasing deals. And getting, which confidence is back, which is great, but I think it just needs to be, again, come back to the due diligence point. Every single deal needs to be really looked at and investigated. Obviously, in the in the regions, but obviously consolidation play with some of these portfolio transactions. I think not obviously much opportunity within London for a lot of overseas guys in terms of looking for trophy assets. So I'd be interested to see if people are going to be moving out into some secondary markets because they're going to be priced out and see if there's some further activity there. And again, just capex is still a big area that needs to be addressed, and all of the owners do really need to invest back into their assets.
And Tina, for you?
I think I would echo Matthew's points in terms of there are certainly a lot of buyers out there. They're looking to be asset aggregators, and in kind of making those platform plays, I think you're seeing a lot of regional portfolios trade that at levels and valuations that are surprising to a lot of us. So,
I think from my perspective, the increasing presence of third-party operators is actually an exciting development. There's a lot of brand consolidation going on across Europe, and many of the big corporate chains are increasingly unwilling to actually sign up for new leases, which for an institutional investor like us would be a challenge. They still sign lease contracts for the key markets, but if you move outside of London, Paris, Munich, for example, many big brands are struggling to commit to leases. Then we actually welcome the presence of third-party operators that assume a franchise, which we like for the liquidity of the investment. And there's an increasing professionalism in there, supported by North American companies like Interstate or coming over and supporting local companies. And I think that's an interesting mix of the power of a brand as a distribution tool and the local focus of the management team. So for us, that's an exciting development.
Excellent. So we've got consolidation and perhaps some price increases in those markets that have been perhaps forgotten about over the last couple of years. Just conscious of time, just look to the room to see if there are any questions for the panel.
This is Timo Grunert from Oetker Collection. I was wondering if the panel could share some thoughts on yield expectations with us. So typical annualized yield expectation, and perhaps what importance does the exit have within that equation?
I mean, being the agent on the panel, I think, I think yield is, it's a function of return, and clearly you've got different business models between certainly the three non-bankers on the table. So, whilst Lisa's looking for the least.
That's why I asked to hear, some differences from the different business models here.
So, I suppose, do the panel sort of factor in their exit yields at the outset?
Yeah, we would not enter an investment without knowing how to get out of it. I guess that's a basic that everyone would support here. So we generally wouldn't, even though we see yields coming under pressure in most markets, as you have more people competing for safe haven products, for high quality hotel products. Yield is coming under pressure when we underwrite our deals. We wouldn't necessarily forecast a massive reduction. We're quite conservative in our approach. So we're looking for long-term stability rather than any short-term turnarounds.
Multiple of earnings, Charles?
Yeah, well, I mean, what's the reality at the moment? I mean, it's some of the stuff that we're looking at. I mean, those multiples are being pushed out, and as I said, I mean, I think that's it's unrealistic at the moment in terms of the opportunities, but that's a function of the money that's in the market at the moment. I mean, our exit is undoubtedly build a portfolio of hotels and aggregate within that portfolio and exit as a single deal. So yes, exit is absolutely vital. I mean, anyone's not going to get into an investment without understanding how to get out of it. But I mean, ours is probably a 5-year play to get to a kind of 20, 25, single assets within that portfolio and exit at that point.
And do you see the value enhancement coming from improved bottom line because of active asset management, or do you see any multiple shifts throughout the holding of your assets?
I mean, I think that you would you would bet that there is a rising tide from now to that, to 5 years out from now. So, in terms of an underlying improvement in the operational profitability of that hotel, it's twofold. It's active asset management, which we do on behalf of our investors and ourselves. But places like Leeds, one of ours. I mean, we would hope that the market is improved from where it is at the moment to where it could be in 5 years' time.
I mean, taking that question on, I mean, what drives price? Well, competition, and Matt, I mean, clearly there's probably a cap to the amount of debt that you're going to be putting into any one asset. So does that mean that the investors are going to have to be taking less return on their equity?
I mean, for us, it is sort of, simple in terms of some debt quantum. It's leverage and serviceability. So it's cash flow. So it's purely down to what that business can service. There's no, we went in terms of as a holder, everything is purely down to what level of debt and what cash it's kicking off to service that debt.
And Tina, your sort of views on multiples from having done your first acquisition into the UK to where we are today. Have you seen them move out? Are you seeing higher multiples paid for the assets that you're chasing?
Absolutely, higher multiples being paid by the market. I think as a firm, do we love it when there's multiple compression on the exit and we can sell an asset for higher than we bought it for? Sure, but as Charles alluded to, the market's quite cyclical, so we typically don't bet on that. We like to make our bets on transformational CapEx, on value-add opportunities, on growing cash flow, on management turnarounds, things of the like. So.
I mean, so just to add one thing there, I mean, you've got to be proactive with these, with any hotel. You can't just take the hotel and hope that the market's going to improve and therefore you're going to get your returns on that basis. What are you actually going to do with the hotel and how are you going to, improve the performance and the operational profitability of it? It's got to be proactive. It's got to be something that it's accretive. It's not just a question of kind of letting the market work for you and hoping that it delivers the returns that you, require. Anyone that gets involved in a hotel investment, on that basis, is surely bound to failure.
Any other questions? Did that answer your question?
I was hoping for some numbers, but
I think in fairness, it's all dependent on location, on asset quality, and on deal structure. I'd support what the guys are saying that those trophy assets in your capital cities have certainly had a lot of money chasing it of late. And I think what we're seeing, not just in the UK, but across Europe, is that because the amount of money that's chasing those central deals, there's a ripple effect, and there'll continue to be a ripple effect because there's been a polarization of the market. You've got super prime assets that will go for much sharper yields than you'll get in the regions. And I think the key is, and all these guys are sort of examples of buying an asset at a price where you know that there's upside.
I think another challenge the market is facing right now is, well, what Charles alluded to, that not every investor looks at a hotel investment purely rationally. I mean, sometimes emotions get involved, and then you see yields that are difficult for people with different investment motivations to understand.
Are there any other questions? I'm conscious that it's close to 5:30 and there's a bar through those doors. I'd just like to thank the Next Generation panel for their contributions. Thank you everyone for attending, and I'm sure each of the panel members will be happy to take questions afterwards.